Welcome to Rooster Reacts. There was another Fed meeting, and we are going to figure out if the Fed has finally figured out what inflation is today. Spoiler, they have not. But I am here. I'm welcomed. Well, Ben Perko left us. He's on vacation. He didn't leave us. But we have somebody, too. His name is Ismail Assad. He is our analyst for our digital asset team, which is just short for crypto.
Hello. Thanks for joining us.
Yeah, and let's just get right into it. Let's see what Ped is talking about today.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate.
He says like the same thing every time.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
Okay, so we can pause it there. So you see that the 7% to 2.7%.
Right.
So it's very funny because they always kind of like to change what metrics they're using.
Of course.
Because, we have to make sure it aligns with us. So if we go to our first slide here, so really when you're looking at CPI, it went from 9.1% to now 3.3%. Okay, so he's using another metric, which is like this PCE number for prices. I don't know. It's always less, but yeah, the real numbers are it went from 9.1% to 3.3%. And so and just so you can also see where 3.3% is historically, right? That's above where it was in 2011, or right around where it was in 2011. 2008 is where is at 5.6%. 2005 is at 4.7%. So really historically, we are at still quite a high rate of inflation.
But he's saying it went from what, 7 to like 2?
Yeah, he said it went to like 7% to 2%, 2.7%.
Artificially lower numbers.
Just a lower number because it fits his.
Sounds nice, right?
It does sound pretty nice, right? Why would we say the real ones? And then if you go to the next slide here, we're also going to just look at, this is just a reminder, we've shown this before, but inflation, when he's talking about inflation coming down, he's talking about the year over year or the rate of inflation. Inflation is up 20.6% since 2021, and It continues to go up higher. And then let's just also talk about how they always talk about how this has been such a great year on inflation. So we will go to the next slide and see how great of a year this has been. All right. So what you're looking at here is I looked at from January to April, right? And I took every single year going back until 1966. And I was like, okay, from January to April, like how much has inflation gone up? So the answer is right there it's up 2.4%. That's that yellow bar.
Okay.
That is the high, like the 20th highest. So it's not number one, it's not number two, but it's the 20th highest. So that's the top 33%. So it's pretty poor, right?
But he's saying it's a great year so far, right?
Yes.
Okay.
Correct. So it's a great year, but we're not even in the bottom half of this.
So I guess you can say anything if you don't contextualize it, right?
Yeah. Yeah, pretty much. It's pretty funny because, I mean, the fourth worst year was the 2022 number. The eighth worst year was 2021. And the 18th worst year was 2023. So literally since 2021, it has been like basically run away, and it's been quite bad.
Awesome.
So
it's great news.
So as he's spreading lies, we'll just continue to highlight what's actually going on. We'll just keep it going there, Sir Powell.
We're strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce
the
our
2% goal. So just so everybody knows about the 2% goal, basically what they do is they put out, this meeting was a big meeting according to the market because they put out their projections essentially. So you get to see where the economists at the Fed are projecting out inflation. Okay. And so they put out their updated forecast. And so we'll put on the screen their updated forecast, which is slide 4. And so you can see, yes, this is their chart ish. It might be hard to read, but this is what it is.
Looks weird.
It is weird. But you basically, all you need to always remember is when they say our goal is 2%, that's the long run. You see that like red bar?
I see. Yeah, it
Yeah.
kind of comes down to 2.
Yeah, exactly. Like that's past 2026. So you have about 3 more years.
So they could take their time on that, I guess.
Yeah, so it's always funny when your goal is like 2 to 3 years out.
Yeah.
And like it's eventually going to get to your goal and so forth. But we've talked about that a lot. But next he's going to talk about like I just want you to listen. So what we were talking about at the beginning about how they like to choose what data. You're going to hear all these exclusions that he's about to say. And it's quite funny.
Okay,
So,
I'm looking forward.
Securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace.
that's right here.
Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023.
That's
Growth of
pretty good,
consumer spending
Yeah.
has slowed from last year's robust pace, but remains solid.
We can pause
And
it
investment
there.
in equipment and
What
So
you
yeah,
say excluding government spending, what else? Net exports?
yeah, it's government spending, exports, I believe imports, and I think one other thing. But yeah, so just take out 3 to 4 things of your economy and you're good.
Yeah.
But like to his credit, though, the economy is like it's pretty fine actually right now. I just find it funny every time they like this huge list of
Very
exclusions.
selective numbers.
Yeah, and then also the best is the next time you hear him talk, he's gonna have different exclusions.
Oh, wow.
And then just kind of like keep coming from left field. But if we go to the next slide, which is slide 5, so really what's going on is, so here's where real GDP growth is that blue line. So what real GDP is versus nominal is pretty important. So real is when you take out inflation. Nominal is your growth with inflation. So most people look at on the real basis. And so we're growing at about 2.9%. So it's like you're not crashing. Like your economy is like pretty much, it's fine. Like it's okay. But like even more, what's really keeping up our economy, why we're not like crashing or doing that bad, is that nominal number is up at like 5.4%. So that's that black bar. So essentially, like most of like our economy is okay because we're growing nominally at about 5%, right? Because it's just all this inflationary thing. So like yes, our economy's doing like it's fine, it's pretty good, but like.
And is that fueled by like what? Government spending, basically?
Yeah, government spending is one of the biggest part. You know, the thing he took out.
Right. Yeah, it doesn't make any sense. I mean,
Yeah, so it's government spending, but it's mostly just like inflation. It goes back to that chart on like slide number 2. Is we increased our inflation by money printing from 2020 all the way to 2022. We were just printing money, and when you're just printing money, inflation goes through the roof, and that's
growth.
And that's
right?
they're calling
Nominal.
it like, and so you just created this really big problem in the economy where you have way too much really debt at the end of the day.
Yep.
And so forth. But so yeah, I wanted to do that, and maybe we can just let's skip to, it would be 5 minutes on your thing here, Genron.
We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress
It's
toward
kinda like,
our
it's
inflation
like the
objective.
same old. What
We'll
he's
need to
talking
see
about, like,
more good data to bolster our confidence that
Kinda
inflation
repeats
is moving
himself a lot.
sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
So we'll pause it there. So when he's talking about like policy restraint, really what he's talking about is it's called the federal funds rate. It's like their central rate. And they basically control it. And so we'll go to slide 6 here. This is what they call like the dot plot. It is number one, always wrong.
Okay.
But it's really basically the Fed has over 2,000 employees, and they have 700. I'll put them in quotes, economists,
Right.
who their goal in life is to predict out where our economy is, like the U.S. economy. That's like
They have
why
one
they're
job.
employed.
Yeah.
Okay, and based on where they see the economy, they try to predict out where they see rates at. Okay, and then they literally put dots of like by end of 2024, this is where we see rates, and that's that first grouping, and then by 2025, and then by 2026, and then this long run thing. And so essentially what you're seeing here is that by 2024 to 2025, they expect rates to go down by a whole 1 percentage point, and then another 1 whole percentage point by 2026. And if you go to the next slide, really like why this is kind of important is this is the base rate essentially for like your economy and for any debt you have as a human. Right. So that's that blue line is what they're talking about. But you'll see all these other lines are above it because the rate just goes up from there. So like the next line is the mortgage. So the rate that you get on a mortgage is highly dependent on this rate that they have. So like when the rates go up really quickly, the rate of your mortgage goes up really quickly. And like, so if I wanted to get a mortgage, I'm going to have to spend like 9%, 8%, whatever it might be. Then on top of that is then like car debt is the same thing. Like if you need car debt, it's going to be like basically the federal funds rate plus X percentage. And then the worst one is consumer credit card rates, right? That's where your rates go up to like 21%, 22%. That's that gray line, right? Yeah. So essentially when he's talking about rates, just understand that that's like the base rate. And if they're raising it, that's going to increase the cost of any debt that you have. And then if you decrease it, that'll make the cost of your debt less.
I see.
And so that's really all he's talking about there. But it's pretty important because essentially what came out of this meeting was this dot plot, which essentially says that they expect rates, that they're going to cut rates once by the end of the year. And then going out into 2026. But I'm not going to look at what they do until 2026 because they can't even predict a month from now. So it's kind of useless. So they really just think that there's going to be one cut, which is 25 basis points. And we'll get into that later about how that it's like benign and like
Right.
That's nothing. But does that kind of make sense?
Yeah, they're saying what, 1% cut by the end of 2025? Was that right?
Exactly.
And
So
then,
from a full like a year and a half from now.
yeah, and then again 2026, which
Right.
we have no idea.
Exactly. And then a long run rate of whatever they put up there. But the biggest thing is that came from this meeting was they think a 25 basis point, which is 0.25%
Right.
of a cut by December.
Okay.
Okay. So yeah, that's what he's talking about when he's talking about restrictive policy, and we'll keep the tape rolling.
Considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
And here's the dot
In
plot.
our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy
It's a
path
projection, but like
will
really don't
adjust
look at
in
that.
order
It's
to
not
best
really
promote
important.
our maximum employment and price stability goals. If the economy remains
hilarious.
solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to
And
fall
so
more quickly
we'll
than
pause it
anticipated,
there, right? So they're maintaining their goals, and it's like, right, like he's just, it's like, here's our goal, here's where we see it, but you know what?
It's all dependent on whatever the data says, right?
Right,
So,
but like they should be projecting out that data.
Right.
And actually, we'll go to slide 9 here. This is the one more. This is what rate. So this is where like rates have been. So just to put in perspective, you need like 12 rate cuts to get back to 2019 levels. So when you talk about one rate cut, it's literally, that's like a blimp on the radar. That's like, you're not going to help anybody. You're not going to do really anything to the economy.
right. Meanwhile, the markets are waiting for it, and they're gonna.
Right.
Everyone's gonna react.
Right. So that's what really happens when he starts talking about rate cuts. What actually happens, like the American people, like really kind of, not that it doesn't matter, but what happens in the short term is before it hits the American people is that the short term, the stock market goes up and it goes up really quick. So when he talks about rate cuts, like
He's moving markets.
he's moving a market, and essentially he doesn't work for the American people. He works for like JP Morgan and the big banks. So he gets them paid every single time he talks about a rate cut. So
That's just great
which is just, yeah, no, it's really fantastic system that we've built here.
for them.
Yeah.
Morgan, of course.
Yeah, exactly. All right, we're going to skip ahead a little bit here. So we just talked about how he's not for the people, but let's listen to him talk to the people.
everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
No, that's good. And then watch now is she's gonna like move his computer and he's gonna get some papers. So that's how you know that these questions he's about to hear are
Pre-written.
They're pre-written. He should know what's coming. But this first question is honestly probably the best question, and it like kind of hits to everything.
Okay.
And the fact that he can't even like he struggles to answer in the middle also talks to about like, and it's like he knows it's coming. It's quite
What
great.
is he pretending to struggle?
No, because that's how you know somebody's lying through their teeth. Actually,
I see.
So we'll just run in here and we'll watch this.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you sort of you
They
could have
increase their
wrong the
projections for
outlook for
inflation.
rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12 months.
So that question, basically what the guy's asking is, you increased your projections for CPI. So he's like, you guys, you economists, you think CPI is going to go up.
Right.
But you're lowering rates. So the guy's like, wouldn't that just kind of, push CPI back up? So like if you think CPI is going to go up from here, like increase.
Why would you cut rates?
Why are you cutting rates? That doesn't make any sense.
Right. So that makes me think, are they going to cut rates anytime soon? What do you think? I mean,
Well, because he's not for the American people. So like the Wall Street is begging for a rate cut right now.
Right.
And I think he'll like just kind of give them what they want. And so he'll talk about a rate cut. I think he might actually do one rate cut. And it's not going to make any sense. And we'll actually like look what's going to happen here. We'll go to slide 8. So what he's talking about, and then what after that, what Powell is telling him is about something called base effects. And so here's what base effects look like, and this is how it works for everybody. So you see the gray bars. When those go down, that's your base effects. What happens is inflation goes up because, like, think of it like a formula. Your numerator is like inflation, like the denominator is that base effect. So like if your denominator goes down, like your headline number goes up, which is the blue boxes.
Right.
And so essentially you can also see those bigger like blue boxes. Those are our projections for CPI. But really what happens is you see towards the last part of that graph and how it goes down really quickly. That's how inflation starts to go up really quickly. So
based on the base effects, inflation is not going down.
it's not going down. It's going to go up. And that's what Powell is basically like trying to say is, oh, well, our inflation forecast went up because the base effects. And as you can see from the base effects, that really just means inflation's going up. So the fact he's even talking about a rate cut.
It's almost like he's just barely hinting at trying to like be honest and say, look, inflation, it's going to go up a little bit, but we're still going to need to cut because you know why.
Yeah, because, but there is no good reason. That's why he can barely answer his question.
I see.
Because it's a lie. Like,
He feels guilt about it, maybe.
well, or he's just like, I don't know how to spin this because, like, this is the math I've learned when I was in 5th grade when I learned about fractions. And this is just an empirical fact. So it's really kind of hilarious. Well, not hilarious. It's kind of sad. And then he was talking about how they make predictions, too. And I think that's going to come up in the next one a little bit more. So we'll just keep rolling it to see the end of this question and answer, because he starts talking about predictions and it's just like, wow, this is really who's predicting our economy.
Okay.
It's pretty good.
In the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting.
Do we have high confidence?
If we were
right?
to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it.
What you said, right? Do we have any high confidence that our predictions are right? No.
None. We have no confidence in our forecasting device, basically.
And we pay 700 economists to be forecasters of our economy. And your head economist is saying, we don't really got any confidence in this.
Just wait and see what the data looks like. We pray that it comes in like this, more positive numbers.
Yeah, I mean, isn't that like it's kind of sad, to be honest. I mean, like this is their only job and they have no confidence in it. Well, we'll just keep rolling because it just gets better.
It would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast month by month that would lead to slightly higher 12 months rates by the end of the year. If we get, good, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Wow.
So that's how you know that he does not care about the
Wall Street
American
Journal.
people.
Chair Powell, if I
And
look
he
at
only cares
the
about
rate
Wall Street.
Just doing
projections, I
what they
see
need him to do.
Exactly. And that's
15 of the
how you know it.
19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one
we
that
can
we
pause
saw
it
this
there.
morning?
So basically what he's just saying and summarizing is that you guys are expecting 1 to 2 rate cuts by the end of the year.
Right.
And that goes back to our just slide 9 of just to put in perspective again to people, 1 to 2 rate cuts doesn't really solve anything. It literally
Right. It's 2 out of 12 to get back to 2019.
exactly. And then to get even further back to 2014, 21 of those cuts. So really, what are they talking about here? Kind of nothing.
Yeah.
It's really kind of wild. We'll have to skip here to the next question.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about
So
it.
I think it's true that inflationary pressures have come down,
yes, let's go.
but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and may.
We'll pause it there. Let's make it easy to understand.
Okay.
So actually, maybe we can do this. If there's import prices are going up, why would you think like what would be like the first place you might look at? If you're importing and the price of stuff is going up.
I don't know, the dollar maybe?
Actually, that's pretty good.
Shipping costs going up?
Shipping costs, right? So where do we get most of our goods? China. So if shipping rates are going up, then you would expect the cost of your imports to go up.
Right.
Oh my, look at this. Here's a chart of shipping rates from Shanghai, and you can see them to the U.S. East, to the West, and the overall index. Shipping rates are up 200% year over year.
That is steep.
Right, that is unbelievably high. The next spot is, how would you know where shipping rates are going to go? Well, let's look at fuel prices. We'll look at jet fuel prices. Jet fuel prices are up about 14% since the beginning of the year. So in case you were wondering about how bad they are at forecasting, they're confused why import prices are going up, but they can't even look at simple rates.
Do you think he really just doesn't know? Like he says, it's hard to know why they're up.
I honestly think he hasn't none of the 700 economists were
To look at shipping or
let's look at shipping rates, or let's look at, I don't know, the price of goods in other countries where we're importing from. I really don't think that they go that second derivative or
wow. You'd think they have access to the information, but
oh no, that's not the problem. I think the problem is incompetence.
incentives maybe.
I don't know, it just baffles me every time. So yeah, when he says I'm not really confident in their projections, I don't think anybody would be confident in these projections because
It's not based on anything.
it's really not based on anything. Actually, there's a wise saying that was once said. It was essentially, if you want to know where the U.S. economy is, the last people you would ask are the people at the Fed. And they're the ones telling
That's a good saying.
and they impact your everything.
Yeah,
So,
they're literally controlling it in a
yeah,
way.
yeah. And we're gonna pause it there, and we're gonna skip forward one more time to my favorite thing.
What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
Good question.
That's a good one.
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data shows.
We'll pause it right
which is
there.
Nobody knows.
He doesn't know. I can explain this to him.
Yeah.
It's called inflation, stupid. Are you literally kidding me? Why are they mad? 78% of Americans are living paycheck to paycheck right now. 78%. Pennies here.
Right.
Pennies.
Prices go up. That would
Right.
make me upset, I think. Right?
Yeah, you 50%, and you know what happens when prices go up? You can't afford things. So 50% of people can't afford a down payment on a house.
I don't know why they'd be upset about that, right?
Why? Why? A third of kids aren't going to college. So like your graduating high school class, a third of them aren't going. 40% of them basically said they can't afford it. So now our next generation is just saying, you know what, higher education, we're not going to do that.
It's
That's
just not worth it anymore.
that's
at
gonna
current
be
prices. Yeah.
exactly right. So that's going to be perfect for, I don't know, increasing our intelligence versus other countries. Great. So let's go to why this has happened. So what you're looking at here with this chart is just look at the bars, the black bars and the red bars. That's real earnings growth. So that's essentially, are you making money over like what inflation is?
Right.
You see those red bars from 2021 to about 2023. So that's 2 years of red bars. That's America not making money above inflation. So they are losing money every year for 2 years, essentially.
That's crazy.
So like basically like their cost of living is going up, and they can't keep the same status because their wages aren't going up. America is doing that for 2 years. So why are they not happy? Oh, I don't know. For 2 years, their status basically as a person went down, even though they were working. And so now we're at the tail end where they're finally making above CPI,
Right.
but you lost 2 years.
Probably just catching up to like where they were before.
Right. So when inflation is up 20% and your wages are only up since 2021 and your wages are only up 15%, there's a 5% gap.
Yeah.
And America realizes that they do not have as much money left over in their checking account every single.
Losing 5%, like actively.
They're losing money. So now let's also look at slide 74, why people might not be happy. This is on small businesses. So small businesses are about 40% of all businesses out there. You'll see on the chart on the left, this is their earnings. So you'll see their earnings are at basically pretty bad. It's at the bottom there.
That's just been declining for years.
It's been declining for years. They can't hire, right? So this is what we call the K-shaped economy, where
Right.
the rich are getting richer and the poor are getting poor, right? So why are people not happy? Well, because their earnings are going down. 40% of people's earnings are going down.
Man.
And there's nothing that's going to change that. We'll go to the next slide 75. 45% of small businesses, they couldn't pay rent. This is that's what it says there. According to Alignable, 43% of small SMBs couldn't pay rent in April. That is a 3-year high. Why? Because your interest rate paid on short-term debt went through the roof because they raised rates so quick. So when you're spending money to cover your borrowing costs, you can't pay on other things. And what's happening is people, they can't pay rent.
So the interest rates are just crushing everybody.
They're crushing them, and especially the small guys, because the small guys get the highest interest rate. So like, let's say interest rates are at 3%, like a JP Morgan gets at 3.25%, but a small business is getting it at, I don't know, like 5%, 6%. Like it's a much greater impact on a small business than a large company,
Right.
because of how much money they make and
They
so
just have
forth.
like less to back it up. They get the worst rate.
Yep. And then we'll go to the next slide 76 of why America is not happy. This could be a fun game show. Let's see. Personal interest payments as a percent of disposable income. So as that bar over there on the left at 2.6%, as that goes up, essentially you have less disposable income. So you have less money to spend.
That's almost, 20-year high it looks like?
Yeah. That's going back to 2007. So yeah, that's good math. That's really good. Let's go to the next slide, actually. Slide 77 on why America is not happy. Credit card. So essentially what happened is as you lose disposable income, you have to pay for goods, right? To keep your status of living. How do we pay for those goods? We take out
Debt.
we take out debt on our credit cards. And so you can see credit card balances were up 17% year over year.
So that's just the highest. These are like highest on the chart.
That's the high. That's above where it was in 2008, 2007. That's that top left chart. And so it's unbelievable. So essentially, people had to take out debt, and then what happens when they take out the debt? They have to pay the high interest rates, which are like 22%, and so now you're in a debt hole.
An endless pit, basically.
Exactly, because to pay like a 2%, 22% rate is really hard. Now we'll go to slide 80. So what happens when you have so much debt and can barely pay it? You become delinquent and or file for bankruptcy. So here's what's going on for consumers. In 2020, you see the chart on the left. That's looking at delinquencies for people the age of 18 to 39. More people, all their credit is becoming delinquent. Essentially, they can't pay it. They're not paying it off. And then, so what happens after you can't pay it off? You file for bankruptcy, and that's consumer bankruptcies on the right. So yeah, why are people mad? Well, when you're filing for bankruptcy, you don't have any money to pay. You have higher credit card debt than you've ever had, and the rate on your debt just continues to go up. Yeah, you get pretty pissed off, and it's all because of inflation. Let's not forget what the Fed did in about 2021 to 2022. They were printing about $2 trillion in money, and they were calling inflation transitory, which basically means, us printing money is not going to have any impact.
It'll go away.
It'll go away eventually, somehow. And so that's when they should have been raising rates, not when they did many years late. Or maybe 1 or 2 years late. I don't have the exact numbers, but that's when they should have been raising rates. Mm-hmm. They didn't. They were calling it transitory because, well, they were in the pockets of the government at the time. Right. And so, yeah, now people are struggling.
So if they were to cut rates right now, would that help these people? But it would also let inflation run away?
No, so that's the Fed has basically shot themselves in the foot because they are so far behind. They don't know how to project. They don't know really how to do anything. Because if they cut, first off, the cut isn't going to lower the credit card rates by that much,
right?
Or the mortgage rates by that much. But what happens is when they're going to cut, the price of everything is going to go up really quick. It goes right back to that base effect chart on, I think it was maybe slide 7, right? We have inflation going up from here. Yeah, this chart. By 2025, we have inflation going up towards 4%. So what basically happens is that number, if they cut, it might just go up to like 4.25%, 4.5%. Inflation will just get larger and larger.
Right. So you're stuck between a rock and a hard place, basically.
Yeah, well, it's a rock and a hard place that they created,
of course,
due to their incompetency. But that's what's going on. So if they cut, the price of things just keep going up. But if they leave it here, this problem is just going to persist.
Interest rates stay high. People can't afford
People
things.
can't afford it, and so forth, and they're stuck in the debt. So essentially, yeah, the only people who are winning are
top of the K?
The top of the K, Wall Street, exactly. Anybody with investments. But the bottom part of the K doesn't have investments because they can't afford the food, the gas, the daily living.
Let alone investments.
There is no money to go towards investments. So anybody with investments is the ones that win, which is Wall Street, which is why they love it when he talks about rate cuts because the price of things go up and they come out on top. They make so much money off of this. Let's go one last slide on why America is pissed. Let's go to slide 99.
Powell should play this game show.
We should get Powell on this game show. This would be fun. All right, what you're looking at here, this is the U.S. federal debt. That's the red bars. And then the blue bars is GDP. We're just going to focus on the red bars here. So this is when people look at like the debt clock. Like we have I don't know what it currently is. It's like 30 trillion or 25 trillion in debt.
Right. Okay,
that's the U.S. government has 25 trillion in debt. That's an issue because we're going to eventually, our debt's going to become larger than our GDP, what we produce.
So you would have to devote all the GDP to paying off the debt and then some of next year in order to ever have a chance of
of
getting
paying
down.
it off,
Yeah,
essentially.
and that's not going to happen.
It's not going to happen because our government just continues to spend. And the more that they spend, the more interest they have to pay, the higher inflation is going to get for the people.
Yep.
Because they can't get inflation down. The only way to get inflation down really on a long-term structural basis would be to get all that debt down. But they're not doing that. They
can't.
literally don't care.
Too many things to spend on.
Right. So really what Powell probably should be doing is actually raising rates as our government continues to print all that money. But that would it would send so many companies pretty much into bankruptcy, and you'd have a depression, and that's not that good. But this is what we have. So they're wondering why the American people are upset. Well, they have no money, and the government keeps spending and screwing them over in the long run. I would be pretty pissed off too there, Sir Powell.
Yep, so would I.
So yeah.
Doesn't seem like a lot of ways out.
No, there really isn't that many ways out. And that was really all I had on this. And we're going to wrap it up there. Thank you, everybody, for joining us. We will be back at the next FOMC meeting. Good luck out there.